Welcome to the topic on risk and return. Meena had participated in a financial literacy workshop conducted by Mr. Ramesh, an expert in finance. She is now doing well in her job and wants to invest some money. However, she is concerned about the investments to be made and the expected returns. She again seeks advice from Mr. Ramesh. Hello Meena, how can I help you?
Hello Ramesh ji. I need your help to invest some money.
That's great. Are you aware of the risks and returns associated with investing?
Risk and return. What does it mean? Can you explain it to me?
By the end of this module, you will be able to understand the relationship between risk and return in investments, promote responsible investment practices by managing expectations of returns and potential losses, develop awareness about different investment types and their associated risk profiles. What is return? When the value of an asset increases after investment, that increase in value is called return. Types of return. Income. This refers to the regular payments you receive during your investment, such as dividends from stocks or interest from fixed deposits. Capital appreciation. This refers to the increase in the value of your investment over time. You earn this when you sell your investment for more than its purchase price. Equity return. Let's say you invest 500 rupees in equity, stocks. You may receive an annual dividend, income of 10 rupees. If you sell your shares at 550 rupees at year end, you earn a capital gain, appreciation of 50 rupees. Combined, your total return for the year is 60 rupees, 10 rupees plus 50 rupees. This represents a 12% return on your initial investment of 500 rupees. Fixed deposit return. Now, consider a 500 rupee investment in a fixed deposit FD. You may receive 30 rupees in annual interest, income. However, upon maturity, you get back your original investment of 500 rupees. In this case, there is no capital gain. Your total return is 30 rupees, which equals a 6% return on your 500 rupee investment. Some investments provide both income, dividends, interest, and capital appreciation, profits from sale. Others primarily generate income with little to no capital growth. Regardless of type, your return represents the total earnings from your investment. Return variations. Different investments offer varying potential returns. These can be classified as low, medium, and high risk or reward categories. Generally, higher potential gains come with greater risk of losses.
You were mentioning risks. Could you also explain that to me?
Yes, let me explain. Risk refers to the uncertainty of achieving the desired return on an investment. The danger of loss. Imagine you invested 500 rupees in the stock market. The value of your investment could decline, possibly dropping to 300 rupees. In this scenario, you wouldn't gain a profit. Instead, you'd face a loss. Volatility and risk. Risk is often measured by volatility, which reflects how much an investment's price fluctuates. Higher volatility means greater potential for significant price swings, both upward and downward. While it offers opportunities for higher returns, it also increases exposure to sudden downturns. Different risks, different investments. Every investment carries its own risks. Here are some common investor concerns. Liquidity. How easily can you convert your investment back to cash when needed? Growth potential. How quickly can your investment value appreciate? Safety of principal. How secure is your initial investment amount from potential losses? Business risk. This refers to the risk associated with the business itself failing. In such cases, debt holders, creditors are repaid before equity shareholders. As a result, equity shareholders typically face higher business risk compared to debt holders. Price risk. In the case of deposits, like FDs, there is no price risk, but stocks carry price risk. While your principal may not be at risk of complete loss, the rate of return can fluctuate. This happens due to volatility in returns. For example, a fixed deposit may consistently give 7% returns every year for the last 3 years. A stock, however, could have delivered 10%, 15%, and 5% returns respectively over the same period. Inflation risk. The risk of inflation means that over time, the cost of goods and services may rise. This implies your money buys less in the future. When prices increase, the real return on investments diminishes. Fixed income investments, like FDs, offer a set return. If inflation rises, your real return decreases because your money has less purchasing power. Stocks, on the other hand, may grow with inflation as their values appreciate over time. Liquidity risk. This refers to the difficulty in quickly selling your investment and withdrawing your money. You may have to sell at a lower price than desired. For example, real estate can be challenging to sell quickly. Interest rate risk. When interest rates change, bond prices can fluctuate. For example, suppose Company X issued Series 1 bonds at 7%. You purchased them 3 years ago, and the investment will mature after 7 years. Now, the same company has issued Series 2 bonds at 9%. What would you do? You'd prefer to invest in Series 2. But what if you don't have the funds? You'd likely sell Series 1 to buy Series 2. Many investors would do the same, leading to a decline in the price of Series 1. This drop in bond value before maturity, caused by rising interest rates, is called interest rate risk. Credit risk. This is the risk that the company you've invested in may fail to pay interest or repay the principal amount. This can happen when the borrower faces financial difficulties, goes bankrupt, or simply refuses to make payments. Reinvestment risk. Reinvestment risk is the possibility that you may not be able to earn the same return when reinvesting your earnings. This can negatively impact your overall investment growth. For example, suppose you invest in a bond with a 5% interest rate. When the bond matures, you receive the principal amount along with accumulated interest. However, if prevailing interest rates have fallen to 3% by that time, you may struggle to find a new investment offering a 5% return. Reinvesting at a lower rate could affect your long-term financial goals. Before investing money, it's essential to understand the rules of investing. Are you aware of them?
Can you explain them to me?
The golden rule of investing, balancing risk and return. Building wealth through investments requires understanding a crucial relationship, risk versus return. Here are 3 key principles to remember. Rule 1. Higher returns often come with higher risk. Wealth creation involves making choices. If you seek significant growth, you must generally accept greater market volatility. Fixed income options, like deposits, carry lower risk but offer lower potential returns. Equities, stocks, may deliver higher returns but come with higher risk of fluctuations. Rule 2. Risk does not guarantee high returns. Risk doesn't always lead to greater profits. Risk means things may not go as planned. Risky investments may offer the potential for higher returns, but they also come with a greater chance of losing money. Rule 3. Define your return requirements. There's no one-size-fits-all perfect return in investing. Your strategy depends on risk tolerance, how comfortable you are with taking risks, financial goals, whether you're saving for retirement, long-term, or short-term needs. Some prioritize capital preservation, safety, even if it means lower returns. Others willingly take higher risks for the potential of greater rewards. Key takeaway: before choosing investments, clarify the type of returns you expect. Remember, return represents the potential to earn money on your investment. Risk reflects the possibility of losing money on your investment. Achieving your financial goals often involves balancing these 2 factors. By understanding this dynamic, you can make informed investment decisions aligned with your risk tolerance and return expectations. Thank you.